Hi, everybody. Welcome to the Middle Class Investor. This is your host, Seth Martin. I want to thank everybody for coming back to the YouTube blog today and watching a little bit about middle class investing. I thought a little bit about the program last week, and one of the things I think I need to do is be a little bit more organized, and so I'm going to continue to try and improve. And one of the things I thought I would do is step back and talk about the different types of investing, just briefly. Basically, what you have today, I guess what you hear on the news and what you hear financial advisors and people of this type talking about is mostly fundamental investing. They talk about cash flow, they talk about price to earnings ratio, they talk about balance sheet, they talk about product releases and how many iPhone sales there's going to be and things like that. And this all comes under the category of what we call fundamental investing. So fundamental investing deals with looking at companies' earnings, their ability to grow their earnings, and then basically paying up today for some future value that the stock seems to be heading towards. Now, obviously, you need some extra financial understanding of companies, and maybe the type of understanding that you don't have as an individual. So, fundamental investing is not always an option for somebody. Plus, it takes a lot of research and time. And the other thing about it is it doesn't always help you understand what the market is doing. So because the market is a discounting futures instrument, it looks at the future value of something. And the challenge with fundamental investing data is it's all data in the past. So what you find if you pursue that is you're going to be lagging a little bit. So you may not know what to do until the next quarter comes, for example, if you're following a particular stock in the market. So fundamental investing is just that. It's looking at financial data, earnings, things like that, and trying to pick value. What can I buy this stock today, and what might it be worth in the future? Another form of investing, kind of what we're doing here, is something called technical analysis. And technical analysis is basically fundamental analysis realized in real time on a chart. So the basic idea is that the price action tells you everything that you need to know about the stock. It tells you the demand for the stock. It tells you the probability of the stock moving up in the future due to what the stock is doing today and the trend. I guess the best way to think about it would be like if you went to the grocery store and maybe a fundamental investor, let's call it a fundamental grocer shopper, might spend a lot of time looking at the labels and looking at calories and dietary information, how many ounces are in it, and what's the price per ounce, and all this kind of stuff, and then making a decision to put it in the basket. Whereas a technical investor would probably just stand at the line and see what people are buying and kind of buy what they're buying. So you're really not making the decision based on the financial underlying information. Although you might, in general, want to say, I'm only going to invest in companies that have earnings, real earnings. I'm only going to invest in companies that are growing their revenues. You might have some criteria like that, but you're not really too caught up in the talk around the particular company, where they're going, what their strategy is, all that kind of stuff. You're really just looking You're trying to judge the demand or the lack of demand for that particular asset. So that's kind of what technical investing is all about. Now, when you further break down technical investing, things that are important under that category are things like trend, momentum, volume. If a stock moves up in a day and it's on very, very heavy volume, what that's telling you is that there's large amounts of money flowing into that stock. Now, what you have to understand about institutional investing and institutional money, you're talking about large sums of money. So they can't just if a large institutional investor wanted to take a position in Apple, let's say, they couldn't just go out and buy 1 million shares in one day. They could, but it would move the stock, and so it's not in their interest to do that. So what they tend to do is they tend to kind of sneak into a position over some period of time, and it may take weeks to months for an institution to do that. So as a technical investor, what you're looking for is you're looking for that type of evidence, and then what you want to do, because you're only going to buy 100 shares or whatever, is you can buy your 100 shares and the market doesn't even notice your little 100 shares, and then as the institutional investor is building their position over weeks and months and sometimes even years, you can ride that wave of demand for that stock over a period of time. That's the theory, if you will, behind technical investing, technical analysis. Now, the tricky thing about technical analysis, it means a lot to a lot of different people. So, some people they build their system based on just the price action. So, as the stock moves up, they say I'm gonna buy I'm gonna look for a low day, and when it crosses above the high of a low day, and these are weeks, by the way. We're looking at a weekly chart of the S&P 500. And we're going all the way back here. You can see the financial crisis is this rather sharply sloping downward line here, and it ended in March of 2009. And we've been, pretty much up ever since. Now, in technical analysis, for example, this is called a rising wedge. Now, the thing about technical analysis, let me just say this real quick, is nothing is 100%, right? So just because you see a rising wedge on the page doesn't necessarily mean, there's no such thing as a rising wedge and this is always what it does. There's a probability of a rising wedge, producing some sort of outcome. I don't know what the probability is right off the top of my head, but it's pretty high. It's around 2/3. So roughly, say 2/3 of the time, a rising wedge that looks like this, where price action is compressed over a period of time, and that period of time could be days or weeks, or in this case, years, right? The price action has compressed within this wedge over the course of the last 5 years. So what that means, kind of what's happening there, is buyers and sellers, there's less and less difference between what they're willing to pay and sell at the market. So that price tightens and it tightens and it tightens. And what ends up happening is it tends to break one way or the other. Now, a rising wedge tends to break to the downside. A falling wedge tends to break to the upside. But that word tends is pretty important. So we need to, maybe one of the most important things you need to know about technical analysis is there's nothing 100%. So you have to learn to think in terms of probabilities, and you have to be able to say, I'm wrong, okay? It's not done what I thought it was going to do, and now I'm going to look for a place to re-enter, either short or long, depending on what your plan was. So technical analysis is one of the things you have to really learn how to do is think in terms of probabilities. It's probably going to do this, but if it doesn't do that, then I'm going to say I'm wrong here, and I'm going to get back in and be long again. Stuff like that. That's kind of the way you have to think. And over time, we'll visit some of these concepts and talk a little bit about them. But I did want to put a long-term chart up here because I kind of alluded to this last week that, bull markets don't last. Pardon me. Bull markets don't last forever, and this pattern has been consolidating, in a tighter and tighter range for some period of time. Now the range has been drifting higher, but the price action is contained in a smaller and smaller. Think of it in terms of a normal distribution curve. There's a mean through this line, and from high to low, the distance to the mean is shrinking with each and every week that goes by. So obviously that can't last forever. As the standard deviation becomes the actual mean, then what will happen is the stock will tend to break one way or the other, or in this case the index. So this is I don't want to have these videos too long, but I did want to introduce the difference between fundamental investing and technical analysis. And basically technical analysis is it's an old science. I mean, it was developed years ago by the Chinese. Is it Chinese or Japanese? I can't remember. The Japanese, I guess, candlesticks. So the Japanese developed. They're the first ones that said, "Hey, these little bodies mean something." So because what it does is it describes what happens to buyers and sellers during that period of time. So, for example, let's just look at one. Let's kind of zoom in on this middle section here. And let's look at this big white candle here. So what happened on this week, or excuse me, this is a month. This is an entire month right here. So what happened is after this month was over, there was an open. The market opened right here at the bottom of this body. Okay. You don't really know whether it went up first or if it went down, but it looks like it might have gone up a little bit and then went all the way down here. So the sellers pushed it all the way down to the bottom of this it's called a wick. So this wick down here extends all the way down to this area, and the sellers pushed it all the way down there. And then what happened? The buyers turned around and pushed it all the way back up to here. So past, way past the open and way past what would eventually be the close. And then the bears and the sellers pushed it right back down to here to close out the month. And that's how that month was formed. Now, when you see a black candle, so this one right next to it, that means the open was up here. So the market opened up at the top of this candle, the top of this called the body. The bulls pushed it up, probably to right there, and then the bears took over and pushed it all the way back down here, all the way to the bottom wick down here, and then the bulls, before the end of the month, pushed it up there, and that's where it closed. So this is kind of how candlesticks work. Now, the relationship between the candlesticks, this is what the Japanese invented or first discovered, I guess is really more of a discovery. They figured out that the relationship between these candles is actually pretty important, and there's all kinds of different shapes that mean things. I mentioned last week about a hammer. A hammer. This is a type of a hammer here. This one at the bottom here. So a hammer. What happens is at the end of a trend, the bears, in this case, the bears push it all the way down here. The bulls push it all the way back up. Now, the closer the body is to the top of the candlestick, the stronger the hammer is. So you can see here, this was kind of a weak hammer, and it pretty much showed that way. So, but we'll talk more and more about this. I don't want to drag on and on. I want to just introduce some concepts each week and try to help you, understand a little bit about the markets. As always, if you have any questions, you can post them on the site. I'll try to look at them periodically and answer them, or maybe I'll just answer them in the next video. I'm going to try to do these videos twice a week. and I hope you come back and visit many times, and let's learn how to trade the markets, or at least be a more nimble investor in this environment. I think that's really the goal. I don't expect all you guys to be traders out there. Some people don't even have an interest in being a trader, but sometimes you can benefit from being nimble. As a retail investor, you don't have to be 100% invested all the time, and actually that turns out to be a pretty huge advantage in the marketplace. So we want to try to use, kind of like Sun Tzu, if you're small, then you're nimble and quick, So that's kind of what we want to be with investors. We want to use our strengths to our advantage and use that against the other participants in the market, which they have huge sums of money and they can't move that money very quickly. So we want to be able to take advantage of that and for our own benefit. So until next time, thanks for visiting the Middle Class Investor, and hope to have you back soon. Thanks for visiting. Take care.